Good morning. I'm Kristen Balasia, head of Automotive Advisory at IHS Markit, and welcome to this edition of Fuel for Thought. Today, I'm joined by my colleagues Vijay Subramanian, Global CO2 Compliance Director, and James Martin, Director Advisory Services. Good morning, gentlemen.
Good morning. Good afternoon, Kristen.
Good morning.
Every day it seems we read about another EV-related ban or major investment. Nothing new, but a lot of complexity and really dynamic space. We see OEMs announcing aggressive product plans across the industry and investment landscape. They talk about battery tech, production, charging infrastructure, and of course, underlying it all is the compliance concern. So Vijay, why don't we start with you? As electrification is paving the way to decarbonization of the transportation sector, phasing out ICEs or internal combustion engines is finally making real progress, but not always at the same speed across markets. Looking at the EU, China leading the way, the US quickly catching up. What are we going to see due to the recent EU proposed legislation Fit for 55?
Thanks, Kristen. Uh, Recently, if you look at last week, the announcement from the European Commission proposed or rechanged the earlier regulatory standards. The earlier regulatory standards were asking for 37.5% of CO2 reduction. But in the overall theme, this particular step is taken by the European Commission to align everything with the overall Green Deal. The objective of the Green Deal is to ensure that Europe hits net zero by 2050 timeframe. And what that equates to from the transportation perspective is a 90% reduction of the greenhouse gas emission by 2050 timeframe. And if you set a target against that or a trajectory to meet the 2050 targets for the transportation, it yields to a further reduction request on a 2030 basis. And earlier trajectory was not so good. So the European Commission did propose a Fit to 55 package, which asks for a further reduction of a 50% of a greenhouse gas, 55% of a greenhouse gas reduction for 2030. And the impact assessments were done, and EU Commission did come up with a revised proposal of a standards for passenger cars and light commercial vehicles, which is asking for 55% of CO2 reduction from the 2021 level. And this is a stretch target for the car manufacturers in terms of the electrification rates. Our first level of assessment says that the current levels of battery electric vehicles needs to go up to meet the 55% of CO2 reduction by 2030. The new passenger car sales into the European market needs to pump it up to a 55% of battery electric vehicles. This is just alone battery electric vehicles, and we also estimate an additional 10% of PHEVs are really required to meet the targets. And this is going to be an further stretch for the light commercial vehicles as well in terms of meeting the targets. And this trajectory is also backed up in a further stringency of asking for 100% of reduction by 2035. That's a big stretch within a 5 years of period where rest of the 45% of greenhouse gas or the CO2 reduction needs to be reduced for the passenger car segment. And this literally puts EU market in a trajectory where by 2035 all the ICE vehicles, which includes plug-ins, hybrid electrics, ICE start-stops, these kind of vehicles needs to be taken out from the market. Whenever I say taken out from the market, all the new cars which are coming into the market post 2035 really required to be a battery electric vehicle. That's the proposal which EU has set last week on a Fit to 55 package. So that's going to be a stringent one as far as our thoughts goes.
Yeah, those are some really significant numbers and pretty dramatic. So considering that, is the capacity available or really seriously being planned to meet these, or is more investment and possibly time needed?
Yeah, in terms of the capacity, right? If you look at Europe in specific, the mainstream capacity investment from the car manufacturers into battery electric vehicles would start to grow somewhere around 2024, 2027 time period. That's where we are looking at each and every particular car manufacturers where they are ramping up their production capacity, predominantly battery electric vehicle production capacity during those time frames. And based on our earlier forecast, that production capacity was 36% low as compared to the recent proposal in terms of meeting the target. In a nutshell, the battery production capacity based on our high level estimates for Europe alone to meet the targets of 2030, it needs to be somewhere around 468 gigawatt hours of production capacity. This is just Europe alone, right? If you look on the other side, China market, which is more than that, because in terms of a stringency level or the NEV mandate criteria of China, and in terms of overall vehicles which are sold in China market, it's roughly around 678 gigawatt hours of production capacity, which is really required for that particular market. But literally, in terms of the Fit to 55 proposal, right, this 36% of increase in the battery capacity production would definitely ask for further additional investment from the car manufacturers and the battery supply chain. But the car manufacturers would have made the mainstream investment, right? Like in terms of the plant, essentially, they would have made the factory investments. But what it would change is they would increase the shift lines, or they would increase the vehicle production lines in those aspects to meet the targets. But for 2035, we really also look at a full battery electric vehicle of 100% into the market. That's going to drive large amount of investment, and these investments are not available right now. But EU Commission has already proposed what levels of investment that can be availed by the car manufacturers, but they have got some kind of a framework to avail of those investments. But definitely, yes, for the car manufacturers, 2030 to 2035 would require the second level of investment. But already the existing levels of investment which are made between 2024 to 2027 would require a slight uplift in this instance.
So James, moving to the US market, the market here has been making major progress, not just in the passenger car space, but in the LCV market as well. Can you talk a little bit about what we're seeing there?
Yes, thanks for the question, Kristen. We've been looking a lot at the light commercial vehicle segment. In fact, we're in the middle of a broad study on that segment and understanding the impact of electrification coming to that segment. It seems to be heating up in some cases even more so than passenger car segments, because what we're seeing is the manufacturers are understanding even better the total cost of ownership aspect of battery electric vehicles. And when we're dealing with in some cases with fleets that manage their own refueling of vehicles and can progress to managing their own recharging of electric batteries, and then again looking at the total cost of maintenance of those vehicles, they can see that within a fairly short time they can recover the additional cost of an electric vehicle in lowered maintenance and lowered refueling prices. So we're starting to see a lot of cargo van, passenger van type of products shifting from gasoline powered or diesel powered to battery electric. And what's even more interesting is we're starting to see a lot of new companies coming into the segment. And that's interesting in a couple of aspects. If you compare the OEMs that are currently competing in light commercial vehicle, they've got product that is fairly profitable, and their legacy products are kind of carrying them through their participation in the market. Well, the newcomers that are coming in don't have legacy product. So that seems like it's a little more difficult to get into the segment. But when you look at the OEMs having to balance how quickly they shift their legacy gasoline, diesel products to electrification, the newcomers don't have that problem. They can come right in with the newer tech, the lower cost of ownership battery electric versions of vans, and in some cases trucks, whereas the OEMs have to balance how quickly do I draw down my legacy profit-making products to bring in the newer battery electric product? And you don't want to do that in a fashion that cannibalizes your higher profit margin, but you also have to keep up with the pace of the new entrants into the market. So we're watching that heat up in light commercial vehicle, and as I mentioned, we're in the midst of studying that in a lot more detail.
So in the U.S. market, I mean, we talk about LCVs and also the trajectory that we're on in the passenger vehicle market on the way to 2030 and beyond. With the current administration in the U.S. focused more heavily on EVs across the board, focused on ensuring local supply. Maybe compared to the EU proposed requirements, what are you seeing in this market to support that trajectory? And so, James, I guess from a capacity, maybe an investment standpoint that we're seeing here in the local U.S. market.
Yes, we're starting to see from again, the legacy automakers, the Fords, GMs, Stellantis, and also the transplants. We're starting to see more investment in architectures that support the battery electrics. So that's one level of investment we're seeing, and we're seeing some investment in the primary components, the drive units, electric motors that are eventually going to replace the internal combustion engines in those applications, as well as replacing the transmission. So we're seeing that shift in investment. But what we're also seeing is significant amounts of investment and significant amounts of partnering in terms of increasing battery capacity in North America.
And you mentioned all of those investments and Vijay, listening to you talk about the dramatic growth and kind of change that the industry has been experiencing and is going to continue to experience over the next 5, 10 plus years. That all has to come from somewhere, and ESG investing is a hot topic. I know we talk about green bonds. Where do you see, or where do we see the continued required investment coming from, Vijay?
Yeah, in terms of all these investments, like predominantly would come from the green bonds, and that's where the ESG element is supporting that, whereby the car manufacturers are assessed based on the level of commitment in terms of what they are proposing for the climate action plans. When you look into past 3 years or 4 years of time frame, there's a lot amount of green bonds which are being circulated and which is being availed to the car manufacturers, like predominantly pretty much most of the car manufacturers are utilized it. That equates to somewhere around 20 billion of investment till date in terms of the green bonds being made available for the car manufacturers to electrify their facilities, to electrify the production plants. And we expect this to grow in the future as well. And if you look at the European Commission proposal, the European Commission proposal is also setting up a framework where they want to assess these kinds of investments which are being utilized by the car manufacturers and the battery manufacturers and the supply chain in this instance, how the funds are being utilized, where the funds are being utilized, and what is the criteria to make these funds being available or grown to a substantial level. A good example is if you look at Europe in specific, they have clearly put a mandate in terms of any kind of green bonds which are being given to the car manufacturers or which are being availed for a development. Till 2026, they were using plugins and battery electric vehicles. They are available for funding, but post 2026, the Commission says that any kind of green bonds can be taken only for battery electric vehicle development. So that's the kind of change which would bring a lot amount of investment into electrification, predominantly into Europe market. And I believe this would also be taken for US and also into the China market as well. When it comes to a financial element, pretty much the framework would be similar for the other markets as well.
So we talk about investment that the industry has to make, and then there's the investment consumers have to make. So maybe Vijay, you first, and then James, EV pricing. So that's always been a point of contention, right? When will there be parity? What will a consumer be willing to pay? how will OEM and government incentives need to play a role along the way? But as we progress now, we're seeing, pricing come down. We're seeing the value of EVs, be reported, higher across the lifetime. What is each one of your views on that? Vijay, we'll start with you.
Yeah, in terms of the battery cost, right? Like for the battery costs have significantly come down, especially when it is quoted against the automotive sector, and it's still significantly dropping in a rate which was not forecasted in any parts of the business. If you look at, like, say, a good example is for Fit to 55, based on the levels of requirement of battery electric vehicle needs to be penetrated to the market, the battery cost is going to significantly drop in the somewhere around $94 per kilowatt hour to an $86 per kilowatt hour. That's the range which we are anticipating for 2030 timeframe, and it was not the same in the earlier standards. What we are seeing is, as the standards get stringent and stringent, the car manufacturers wants to produce lot amount of battery electric vehicle. This brings the economies of scale for battery electric vehicle production, which in turn, to a certain extent, reduce the battery cost significantly. And especially in the period of 2025 to 2030, the reduction is pretty drastic in terms of a 40 to 46% of reduction is what we are expecting from the learning curve perspective, from the supply chain perspective, and from the raw material sourcing perspective. And in terms of a tipping point, how this is managed as a tipping point. When we speak about tipping point, the tipping point is not global. Each and every market has got its own tipping point depending on the standards. To the levels of stringency in terms of a tipping point, wherever the standards are quite stringent, the tipping points do apply or become earlier. Whenever the stringency goes away, the tipping point gets later. In the first instance, if you look at the tipping point, China somewhere around 2026, 2027 is where we are expecting a tipping point of a battery electric vehicle for a 60 kilowatt hour battery capacity kind of a vehicle, somewhere to achieve the tipping point for China. But the same tipping point assessment conducted for the EU market is quite late, somewhere around 2029, and this would have changed on a Fit to 55 package somewhere to the timeframes of 2027 to 2028. So the key message over here is all these tipping points and the battery cost, right? It has got a direct relation or correlation to the stringency of the regulation. So whenever the regulatory standards gets updated or revised, this goes down to the levels which were not noticed in the past. Another good thing which we are also keeping an eye on is about the greenhouse gas targets for the U.S. market. We anticipate a big change about to happen for 2030 because U.S. is also aligning with the 2050 net zero emissions, which might require further or really big levels of electrification somewhere around 2030 timeframe. This would once again push the battery cost for the US supply chain as well. So that's what we are keeping an eye on, and it's changing on a day by day basis. That's how I would put it. James, over to you if you want to comment.
Yes, the things that I would add, and you've made some very good points there, but the things that I would add, and more specific to the North American market, is, I'd mentioned some of the partnering that has been going on within the battery supply chain. I mean, if we look at GM, they've got 2 Ultium plants that are under construction now, and 2 more to be launched in the U.S. that they've announced, just not location yet. And I would even go further to say that we're likely to see at least 1 plant each in Canada and Mexico to support vehicle manufacture they've got going there. So as through the partnering, as they're able to bring the price of the batteries down, that's going to get closer to that inflection point with ICE-based vehicles. The other thing we need to take into account in terms of the cost structure, and then therefore the pricing structure of battery electric vehicles versus ICE vehicles, is we have to look at what goes away. The engine and transmission go away, and in a typical ICE vehicle, that's about 30% of the cost of the car. So that's going away. Now, of course, that's replaced by the much higher cost battery, and of course, electric motors and drive units. But the electric motors and the drive units are fairly mature in terms of cost, and there's a pretty good understanding of what those costs are. So the reduction in cost of the batteries is only going to help the pricing and the cost position. But GM's not the only one that's partnering on batteries. Ford is partnering with SK Innovation to produce batteries in North America. Stellantis has started to outline their strategy, and that involves partnering on battery development and battery manufacture. So that's going to help them pull the cost down. But let's look at what else is not in the vehicle. In the electric vehicle, you don't have an exhaust system. That's a pretty significant element of cost that goes away. You also don't have included in the development cost of the vehicle the need to certify emissions. So that's going to take some amount of vehicle on a per unit basis. I mean, some amount of cost on a per unit basis out of the cost of the vehicle. So it is still kind of riding the trajectory of the battery cost going down, but removing exhaust systems, the number of fluids that have to be replaced on a periodic basis, the cost of the engine and transmission, all those costs go away. And what's even more attractive if you're a fleet owner in a light commercial vehicle market, for example, I talked about the fluids, the need for replaceable fluids going away or being reduced. That gets back into that total cost of ownership that I was talking about earlier. And as we see commercial fleets realizing that knowledge eventually does get passed on to the passenger vehicle owner. And when they start to realize, I don't have to worry about servicing an exhaust system, I don't have to worry about oil changes, I don't have to worry about coolant changes as much, and my brake service costs are also going to reduce, that gets factored into the owner's decision on where that price point is, where they're comfortable with buying a battery electric over an ICE.
Thanks, James. Yeah, and I think with the number of storms we've had in this area and the home power outages, a few people would like to be able to plug some things into their vehicle or charge up their vehicle as well. Well, with that, we'll end it there. And I want to thank Vijay and James very much for the time and insights this morning. We'll be back with more Fuel for Thought next month. To opt into our newsletter that provides more information on this topic and others, visit ihsmarket.com/auto newsletter.